I'm sure you have heard of the saying that rent money is dead money. And I'm sure people have told you that you should be paying your own mortgage instead of paying your landlord's mortgage, especially in such a low interest environment where it is often easier to service your mortgage than to pay rent. While both of these points are true and accurate, it is not always a straightforward answer to simply buy a property and you'll be better off. Because if you buy the wrong property in the wrong location, you can find yourself being stuck with an underperforming asset that is more of a liability than an asset. I understand that not everyone wants to be a property millionaire or retire by the age of 40, but not all properties are created equal, and if you get yourself stuck in the wrong property, it will 1. Underperform, and 2. Give you a lot of stress later down the track. If you have been watching my videos for a long time, then you will know that I am a very passionate property investor and I love property, and I would love to have that beachfront mansion one day. However, as of right now, even though I could afford that beachfront mansion, I choose to rent a 2-bedroom apartment and share it with a housemate. In today's video, I'm going to share with you why I choose to rent and why I think the strategy of renting where I want to live and then buying where I see value and where I can afford has built me a lot of wealth and has helped me reach financial freedom by the age of 25. Hey guys, welcome back to the channel. My name is Zane and I make weekly videos on the topics of personal finance, property investing, and the Australian housing market. So if that's something you would like to learn more about, definitely smash that like button right there and subscribe to the channel for more content just like this. As always, this is not financial advice. I'm simply sharing with you my personal opinions and strategies, and I will always recommend you to do your own research and seek professional help, and don't just rely on the opinions of some guy you found on YouTube. Let's start by talking about renting. Is renting really as bad as they say? Over the long term, most properties will increase in value. There might be some small corrections or bumps along the way, but if we zoom out, we can see that it is a very clear uptrend. Based on this information, if you spend your whole life renting and you never become a homeowner, this is going to make you fall behind and make you miss out on a lot of capital growth. This will also create a wealth gap between the haves and the have-nots. We have seen this over the last few decades. The property owners have been riding this crazy property boom, and this has made them filthy rich, while the people who do not own property are falling further and further behind. As we can see in this graph provided by the Australian Bureau of Statistics, yes, the Australian housing market has had some small bumps and corrections along the way, but over the last 35 years, it has gone up significantly faster than the Consumer Price Index. The comparison to the CPI is very important because it means house prices have beaten inflation and improved the purchasing power of homeowners. And this is the ultimate goal of investing, to achieve a return that beats inflation and puts us in a better position. As you can see, the Great Australian Dream is very important in building wealth and building a strong foundation for you and your family. So renting for the rest of your life is probably not a good idea. However, this now brings us to the next point. Buying a property for the sake of just buying a property is not going to get you ahead. In fact, it might make you even further behind, because not all properties are created equal. Allow me to explain. Let's start by looking at this article by news.com.au titled "Why First Home Buyers Can Only Afford Apartments." You guys already know that I bash on apartments a lot and that I'm very biased towards freestanding houses because I think, in my personal opinion, the land component of a property is what grows in value. So it will make sense for us to try to get as much of that land component as possible. Look, I don't have anything against apartments, and there are definitely some quality apartments out there that have performed very well over the last few decades. These very unique and well-built apartments in good locations where there isn't a massive oversupply have often outperformed houses and townhouses. However, these apartments are very hard to find and they are very rare. And the chances are, if you are buying an apartment right now, you are probably buying one in a very oversupplied market with a lot of additional supply on the way. This is going to lead to price stagnation and very limited capital growth because more and more supply is being added to the market, and people who are looking to buy in this market now have more options to choose from, and there is no competition to drive up prices in this particular market. With so many apartments being built at the same time and so quickly, and with all the developers chasing profits and cutting costs, a lot of these new apartments are defective and it is simply not a good investment. I've gone over this in a lot more detail in one of my previous videos, so I won't talk about this too much, but I completely disagree with this article, and I don't think apartments are the only options for first-home buyers. There are definitely much better options out there. Reading through this article, we can clearly see that this couple has a very decent income and quite a substantial deposit saved up, but they are struggling to buy anything in Sydney, and this is quite common in the most expensive property markets of Australia. Look, what I'm about to say next might not be something you want to hear, but buying your dream home as your first property is often not the best way to approach home ownership. Allow me to explain. Most people want to buy their $1 million or multi-million-dollar dream home right off the bat, and this is simply not realistic because you are competing with people who are much higher income earners and who have spent much more time building up their wealth, and they have more money to play around with. People always complain about not being able to buy into the best suburbs of their local markets because it is too expensive. For me, that's like saying, hey, this is my first day at the job, but I want a pay rise and I want a corner office, exactly like the one my boss has. It takes a lot of time for you to build up your borrowing capacity and your wealth to be able to afford one of these blue chip, highly desirable suburbs. And while you are waiting, while you are saving up for your deposit and improving your wealth, there is absolutely nothing wrong with buying a property in a market where you can afford and renting where you want to live. I myself started off wanting to build my dream house in Doncaster, which is one of the highly desirable $1 million suburbs in Melbourne. When I was 24, my business was doing very well, and I wanted to use my newfound wealth to buy a property and then build a brand new mansion in Doncaster. Then I sat down and went over the numbers. Even if I put down a 20% deposit for this dream house plus new build, I will still be paying more than $6,000 a month in repayments. And if I did this, my entire life would just be working my ass off just so I can make more money and service this mortgage. And this whole time, this dream home of mine is not going to produce any income for me. And this makes it more of a liability than an asset. And I'm essentially praying that the growth I will see in this property is going to be enough to cover my short-term losses over the long run. Eventually, I decided to do a quick renovation and flip the property for a decent profit, which turned out to be quite a good idea because the property was sold in 2017, just before APRA stepped in to cool the Melbourne and Sydney property markets. Then I thought to myself, there has to be a better way to approach this than to drown myself in debt or to buy or settle for a cheap apartment. And this was when I discovered a strategy that has helped me build a multi-million-dollar property portfolio by the age of 28. Now, if you transfer me a once-off payment of $10,000 or join my Patreon for $2,000 a month, I'm going to share this secret with you. I'm just kidding, guys. You guys all know that I am very transparent and all of my content is free. This was when I discovered the strategy known as rent vesting, where I rent what I want to live and then simply use the money I have left over to invest in markets where I saw opportunity. So instead of putting all of my money into a dream home and drowning myself in debt, I decided to rent a 2-bedroom apartment in Footscray for $1,600 a month. And I decided to also get a housemate to share that with me, so I'm now paying only $800 a month. $800 a month is much better than paying $6,000 a month in repayments for my dream home. This also meant I had much more money to invest into markets where I saw much more potential and much more value than Melbourne. So I purchased 2 investment properties in Hobart, which were completely cash flow positive. And then I used the cash flow from that to purchase another 2 in Launceston, and then another 2 in Bendigo, and now another 2 in Perth. Now here is the best part. If I was to change the repayments on my investment property to interest only, my entire portfolio will actually generate $6,000 of passive income every single month. Meaning that if I wanted to, I can now go out and buy my dream home and pay the $6,000 a month of repayments on that dream house and still achieve a cash flow neutral result. Here is the thing. The only reason I was able to achieve this and that this is possible is because I didn't buy my dream home right off the bat, and I decided to delay gratification and invest in markets where I saw value and where I could afford, so those properties can now work hard for me and help me achieve my goals. Now, going back to the article that says first home buyers have no choice and they can only afford to buy apartments, That is simply not true. There are so many opportunities out there as long as these first-home buyers are willing to look outside of their local markets. I know all of this can seem a bit daunting, so let me give you a bit more information on how I first started reinvesting, so you have a rough idea of what to expect. I first started reinvesting by buying two $320,000 houses in Hobart. These properties had a combined rental return of $760 per week, which adds up to be $40,000 a year. If we now minus the property management fees and vacancy allowance of 10%, council rates and water rates of $5,000 a year, insurance of $1,800, land tax of $1,200, and the principal and interest repayments of $26,000 a year, it will provide us with a surplus cash flow of $1,000 a year, which means these properties pay for themselves. And all we have to worry about now is paying rent for the place we want to live. Melbourne and Sydney has some of the lowest rental returns in Australia, which is great for renters because it means the renters will only be paying a fraction of what the owners are paying in repayments. Remember, I don't plan on renting forever, and neither should you. This is only for the short term until our portfolio is sufficient enough to service our mortgage on the dream home. I know a lot of you guys are working very hard to get into your dream home, and I'm sure you guys will get there one day. But while we are working towards that goal, I think it is very important to have some exposure in the property market. Look, I am not a financial advisor and I can't tell you what to do. But if you're thinking about investing in an apartment because your friend told you so, or for the great tax benefits, I'll suggest you to do some research into how much supply is being pumped into these markets, and to just think about some of the other options that you might have. Don't get frustrated when you try to buy a dream home and you get outbid. You're literally competing with people who have spent much more time building up their wealth and climbing the property ladder. It is very important to understand your own financial situation, and to know that stretching yourself financially is never a good thing. It is actually quite dangerous. Alright guys, this brings us to the end of the video. I hope you guys learned something new and that you guys enjoyed the video. I want to thank you guys for watching until the very end, and if you got any questions at all, please feel free to contact me down below. I've left my email and my Instagram. Stay safe and stay productive, and I'll see all of you guys in the next video.